So, you want to own an oil company. Drill into the ground, pull up something the entire world needs and will pay almost any price for. Watch the money come in. Here's the part nobody tells you. The oil is very rarely the hard part. Finding it, pricing it, and selling it are all solvable problems with well-understood playbooks. The thing that has bankrupted more oil companies than dry holes, price crashes, or bad geology combined is debt taken on during the good years that nobody planned to still be carrying when the good years ended. Let's start with what it actually costs to get a barrel of oil out of the ground, because this is the single number that determines whether any of this makes sense, and it's called the break-even price. It's the minimum price oil needs to sell for to make drilling a new well worthwhile, and the range across the industry is enormous. Large companies producing more than 10,000 barrels a day report needing around $59 a barrel to profitably drill a new well. Smaller operators producing less than that need closer to $68. Within a single region, the variation gets even more extreme. In the Permian Basin, break-even prices can range from roughly $46 a barrel in the best rock to over $87 in the weakest, depending entirely on geology that isn't visible from the surface and can only be confirmed once you've already spent millions drilling. That gap between large and small operators isn't a coincidence. It's structural. Bigger companies drill more wells, spread fixed costs like rig mobilization and completion crews across a larger base, and can negotiate better pricing with oilfield service providers. A small operator paying $44 a barrel just to produce oil that's already flowing, before any of the cost of finding and drilling it, is operating with almost no margin for error. A large operator producing that same barrel for $26 has room to survive a price crash that would wipe the small operator out completely. Now, here's the part of this business that makes it fundamentally different from almost everything else we've covered on this channel. You don't set the price of what you're selling. Oil is a globally traded commodity, and the price you receive on any given day is determined by OPEC production decisions, global demand shifts, geopolitical events on the other side of the planet, and financial speculation, none of which has anything to do with how efficiently you run your own operation. You can control your break-even cost. You cannot control the number on the other side of that equation, and the gap between those two numbers, your cost and the market price, is where every dollar of profit or loss in this industry actually lives. This creates a trap that has destroyed more oil companies than any single bad well ever could. During periods of high oil prices, when cash is flowing and credit is cheap, the temptation to borrow heavily and drill aggressively is enormous, because every well drilled at $70 oil against a $50 break even looks like free money. The problem is that drilling programs, once financed, don't stop the moment prices fall. Debt service doesn't pause, and a company that borrowed heavily to expand during the boom is exactly the company with the least room to maneuver when the price inevitably drops, because it isn't just facing lower revenue, it's facing lower revenue while still owing the same amount of debt it took on when revenue was high. There's a story that shows exactly how this trap closes, and it involves a company that was, for a period, one of the most celebrated names in American energy. Chesapeake Energy was founded in 1989 by Aubrey McClendon, who saw the promise of horizontal drilling and hydraulic fracturing years before most of the industry took it seriously, and built the company into one of the largest natural gas producers in the country. By 2008, Chesapeake's market value had reached approximately $37 billion. McClendon was aggressive, charismatic, and utterly convinced that acquiring land ahead of competitors was the entire game. And for years, that conviction was rewarded. The debt behind that expansion, though, kept growing faster than the company's ability to pay it down. Between 2010 and 2012 alone, Chesapeake spent roughly $30 billion more on drilling and leasing than it actually earned from producing oil and gas. By 2012, the company's market value had shrunk to roughly 1/27th the size of ExxonMobil's, while its net debt load, according to analysts at the time, was actually double Exxon's. When new CEO Doug Lawler took over after McClendon's ouster in 2013, he reportedly discovered a company carrying nearly as much debt as ExxonMobil and Chevron combined, a staggering figure for a company a fraction of their size. Internal financial habits during the boom years had been just as loose as the balance sheet: a wine collection hidden behind a broom closet, a $110 million bill for 2 parking garages, and a corporate campus modeled after a university, complete with its own beekeepers. For years afterward, Chesapeake's management worked to unwind the damage, cutting over $20 billion in leverage and financial commitments through asset sales and restructuring, restructuring. It wasn't enough. When the COVID-19 pandemic collapsed global oil demand in early 2020, Chesapeake reported an $8 billion loss in a single quarter. And by June of that year, the company that had once been valued at $37 billion was trading with a market capitalization of roughly $5 million. It filed for Chapter 11 bankruptcy, eliminating approximately $7 billion in debt through the restructuring process. Aubrey McClendon himself never saw the final chapter. Indicted on federal bid rigging charges in 2016, he died in a car crash the very next day, at a moment when investigators noted he was driving well over the speed limit into a highway overpass. Here's the structural lesson underneath that collapse. Chesapeake wasn't destroyed by bad geology. The company's engineers were, by most accounts, genuinely skilled at finding and extracting hydrocarbons. It was destroyed by a fundamental mismatch between how fast the company borrowed money during good years and how much cushion it had left when a genuinely bad year, a once-in-a-generation demand shock, finally arrived. The debt that funded the expansion never went away just because the price of oil did. It sat there, fixed and unforgiving, while revenue collapsed underneath it. Now compare that to a company that took almost the opposite approach to the exact same industry. EOG Resources, headquartered in Houston and operating independently since 1999, built its entire strategy around a concept it calls premium drilling, a strict economic screen that only greenlights wells expected to deliver at least a 30% after-tax rate of return at a benchmark oil price of just $40 a barrel, well below what most of the industry needs to break even at all. Rather than chasing production volume for its own sake, the way Chesapeake did during its expansion years, EOG explicitly prioritizes returns and inventory quality, using strict internal economic filters before a single well gets drilled. That discipline shows up directly on the balance sheet. EOG has maintained net debt to capitalization below 5%, a fraction of the leverage that sank Chesapeake, giving the company enormous flexibility to accelerate drilling when prices are strong and pull back sharply when they aren't, without ever risking the kind of debt spiral that destroyed its Oklahoma-based rival. In fiscal year 2024 alone, EOG reported $23.68 billion in revenue and record net income, built almost entirely on a portfolio of what the company calls premium locations, acreage specifically to remain profitable even in a genuinely weak price environment. The company's own materials describe having identified over 3,200 premium drilling locations capable of delivering strong returns even at low commodity prices, and more than 2 billion barrels of oil equivalent in estimated resource potential built around that same discipline. The difference between these two outcomes wasn't access to good geology. Both companies operated in some of the same core American shale basins. It wasn't even primarily about talent, since both employed genuinely skilled geologists and engineers. The difference was what each company chose to do with the cash flow generated during good years. Chesapeake treated strong prices as license to borrow more and drill faster, expanding the company's exposure right as risk was quietly building underneath it. EOG treated strong prices as an opportunity to accelerate development within a strict, predefined return threshold, and treated weak prices as a signal to pull back, protect the balance sheet, and wait rather than a crisis to borrow its way out of. That brings us to the structural risk sitting underneath this entire industry. And it isn't the price of oil itself, since price volatility is simply a permanent feature of this business that every operator has to live with. It's leverage taken on with the assumption that today's price will persist indefinitely. A company financed conservatively enough to survive a genuinely bad multi-year stretch at low prices can ride out almost any downturn the market throws at it, because the debt service never outgrows what the business can service, even in a weak environment. A company that borrowed against optimistic price assumptions is betting its entire survival on the cycle staying in its favor indefinitely, a bet that eventually, reliably, loses. Zoom out across the industry, and the pattern becomes obvious. The oil companies that survive across full commodity cycles are almost never the ones that grew fastest during the boom years. They're the ones that treated debt as something to be minimized rather than maximized, that screened every drilling decision against a return threshold conservative enough to survive a genuinely bad year, not just an average one. The companies that fail are almost always the ones that mistook a run of high prices for a permanent state of the world and financed their growth accordingly, right up until the cycle turned, the way it always eventually does, and the debt that once looked like leverage for growth became the exact mechanism of their collapse. So does owning an oil company actually work as a business? The honest answer depends almost entirely on financial discipline, not on how much oil actually sits underneath your acreage. In the optimistic version, you screen every drilling decision against a conservative return threshold, keep leverage low enough to survive a genuinely bad multi-year price environment, and let disciplined capital allocation compound across decades of commodity cycles. The way EOG turns strict return discipline into one of the most resilient balance sheets in the entire industry. In the realistic bad version, you borrow aggressively during a period of high prices, expand production on the assumption that today's favorable environment will simply continue, and discover, the way Chesapeake did, that the debt taken on during the good years doesn't disappear the moment the cycle turns against you. It just sits there, waiting for the exact moment you can least afford it. Neither outcome has much to do with how much oil is actually in the ground. An oil company was never really a bet on geology. It's a bet on whether the balance sheet you build during good years can survive the bad ones that are, with total certainty, eventually coming.